Equities down this morning by about 1/3%. This is the view on Wall Street from Scott Chronert of Citi, writing the following. Recent signs of consumer slowing are concerning. We bias in favour of a combination of defensive names and secular growers that have been more heavily investing in their businesses. Scott joins us now for more. Scott, welcome to the programme, sir. We need to take a bit of a beat and talk about what's developing in the bond market and what ultimately it means to you and the team in equities, Scott. What happens when we get to these kind of levels in bonds? What does it mean to you?
Jonathan, well, it means a couple of things. I think first and foremost, you look at the potential impact of higher rates in terms of a slowing effect in terms of demand for new credit. That's pretty straightforward. Additionally, from an equity perspective, it's mostly about valuations. And essentially, when you're looking at how to value securities, it's a combination of where you think near-term fundamentals are going, but it's also how you discount future earnings 5-10 years down the road and assign a valuation to terminal values. And so what ends up happening here is when you back up yields, you begin to change the math, and those future earnings are worth less now. So the bottom line is that from a valuation impact, when you look at this current trajectory in 10 years in particular, where we focus, it's a gating factor potentially on future economic activity, but essentially real time, it's an overhang in terms of the valuation setup for U.S. equities.
When you look at the policy down in Washington, Scott, we do have the One Big Beautiful Bill passing through on the House side, and the bond market seems to be pushing back on a number of issues. But what if they didn't do anything and we would have a tax hike at the end of the year? What would the bond market do then?
It's kind of pick your poison, right? So what you would get with the tax hike, which was where we were a year ago at this time looking at potential presidential election outcomes, is that you would have a different influence where you would probably begin to slow aggregate spending levels. You would crowd out essentially expenditures because more of your income is going to taxation. So essentially, it's to be careful what you wish for. The bottom line, Emery, is that we've been living in a fairly fiscally stimulative environment going back to the pandemic. That's when you really began to see your debt to GDP rise. And now with the Fed rate policy in the rearview mirror, you're also looking at the debt service component kick in as well. So essentially, from my perch, from an equity perspective, you get the deficit spending. That's fiscally stimulative. That's actually pretty good for economic activity and probably for corporate fundamentals. But the offset is what you're doing in terms of paying forward now for future pain in terms of the risk of higher for longer rates, the valuation impact, and the ultimate slowing effect that can have on economic activity.